What if I told you the largest Bitcoin holder on the planet just quietly opened the door to selling $5 billion of it? Not rumors, not speculation from some anonymous account, an actual board-approved framework that lets it happen. For years, the entire thesis around this company was simple. They buy Bitcoin, they never sell. That single idea made them a legend in this space and turned their founder into one of the most watched men in finance. But that era just ended. Quick disclaimer before we go further, because this matters. Nothing in this video is financial advice. I'm not telling you to buy, sell, or panic. I'm breaking down what's actually happening, why it matters, and what smart money is watching next. What you do with it is entirely up to you. Now, back to the story. This isn't a company dumping its Bitcoin overnight. It's something quieter, and in some ways, more unsettling. A mechanism, a framework, a door that's now open, when for 6 years it was welded shut. And here's the twist almost nobody is talking about. Markets don't wait for the actual selling to happen. They react to the possibility. History shows the fear of supply hitting the market can move prices just as hard as the selling itself. So in the next 20 minutes, we're covering 4 things. What this company actually announced, why analysts are suddenly whispering about supply risk, why this might be far less bearish than the headlines are making it sound, and the one number every single Bitcoin holder should be watching over the coming weeks. Stay with me until the halfway mark, because what I'm about to show you about how this framework actually works changes the entire way you'll read the next strategy filing. Morning, afternoon, or night. Wherever you're watching this from, drop it in the comments. I want to know who's watching this thing unfold in real time with me. Let's set the stage properly. The company is Strategy, formerly known as MicroStrategy, a business intelligence firm most people had never heard of until it made one of the boldest corporate bets in modern financial history. Instead of holding cash on its balance sheet, it converted itself into a Bitcoin acquisition vehicle, raising billions through debt, preferred shares, and equity to buy and hold Bitcoin as its primary treasury asset. Today, the company holds 843,775 Bitcoin. That is not a typo. That is roughly 4% of all the Bitcoin that will ever exist, sitting on one balance sheet. Every institutional desk on Wall Street tracks this company's filings the way sailors track weather fronts. When the biggest holder moves, ripples follow. But before we get into the $5 billion plan, you need to understand why even the possibility of this company selling scares the market so much. Because once you understand that, the headlines start to make a lot more sense and a lot less sense at the same time. Let's go back to the beginning, because the scale of what happened here is easy to forget once you're used to seeing the numbers. In 2020, this company made its very first Bitcoin purchase. At the time, it looked like a curiosity, a software company parking some spare cash into a volatile digital asset. Nobody expected what came next. Over the following years, the buying didn't stop. It accelerated. The company issued convertible notes. It issued preferred shares. It tapped equity markets again and again. Every dollar raised was funneled almost religiously into more Bitcoin. What started as a treasury experiment became something else entirely, a publicly traded proxy for Bitcoin itself. Investors who wanted exposure to Bitcoin without holding it directly could simply buy the stock. And for years, that trade worked beautifully. The Bitcoin pile grew larger every single quarter. Analysts stopped calling it a software company with a side bet and started calling it what it had become, a Bitcoin treasury company, full stop. Here's a way to think about the scale of this. Imagine removing the largest whale from an ocean. Every fish in that ecosystem notices the shift in current. That is exactly why every filing from this company gets read line by line on trading desks around the world. When a position this large moves even slightly, the entire market feels it. By 2024, the company had already announced what it called its 21-21 plan, a target to raise $42 billion, combined through equity and fixed income to keep buying Bitcoin. In 2026, that ambition grew even larger into what's now referred to as the 42-42 capital plan, targeting $42 billion in common equity and another $42 billion in fixed income and preferred instruments. The company became more than a business. It became a bet on an entire asset class wrapped inside a publicly traded ticker. But here's the part almost nobody was paying attention to while all this buying was happening. Every dollar raised through preferred shares and convertible debt came with strings attached, obligations, interest payments, dividend commitments. And those obligations don't care what Bitcoin's price is doing on any given day. That detail is about to matter a lot more than most people realized. So what actually happened here? In recent weeks, the company formalized what's being called a capital management framework, sometimes referred to as a digital credit capital framework. On the surface, it sounds like typical corporate finance language, but underneath it, something notable shifted. The framework allows the company to sell Bitcoin in a structured and board-approved way to fund 3 specific things. First, building up a United States dollar reserve of up to $1.25 billion. Second, covering roughly $1.76 billion in annual preferred stock dividends and interest payments. Third, funding up to $2 billion in buybacks across both common stock and preferred securities. Add those numbers together, you get a theoretical maximum of around $5 billion in Bitcoin that could be sold under this framework. Let's be precise here, because precision matters. This is not an announced sale of $5 billion in Bitcoin. Nobody sold $5 billion worth in one transaction. This is an authorization, a ceiling, a tool the company has now given itself permission to use, if and when it decides to. Why now? The simplest answer is math. Bitcoin's price has pulled back significantly from its all-time high above $126,000 set back in October. At current levels, hovering in the $63,000 to $65,000 range, the company's average cost basis of roughly $75,476 per coin means its enormous position is sitting on an unrealized loss of close to $9 billion relative to cost. That doesn't mean the company is broke, far from it. But it does mean that raising fresh equity to cover dividend obligations becomes a lot less attractive when your stock price has also been under pressure. Suddenly, having a self-funding mechanism, one that doesn't dilute shareholders further, starts to look like discipline rather than desperation. So why are headlines suddenly talking about supply fears if this is framed as prudent balance sheet management? That's where things get genuinely interesting. Here's where we need to slow down and actually look at the machinery underneath this company's balance sheet. This company didn't just buy Bitcoin with cash sitting around, it bought Bitcoin using debt, convertible notes that mature on specific dates, preferred stock that pays out fixed dividends, rain or shine, bull market or bear market. Those obligations exist whether Bitcoin is at $126,000 or $63,000. Preferred shareholders get paid before common shareholders. That's not optional, it's contractual. So when Bitcoin's price falls and the stock price falls alongside it, raising new equity to cover those dividend payments becomes both harder and more dilutive to existing shareholders. This is where the quiet risk lives. Not will Bitcoin go to zero? The real risk sits inside the capital structure itself. Interest costs, refinancing needs, dividend obligations that don't pause for market conditions. Could sustained financial pressure eventually force the company into selling more of its core asset just to keep the lights on for its creditors and preferred holders? Possible. Yes, clearly, since the framework itself now exists specifically to allow it. Likely. That's a completely different question and one we're going to dig into properly. The company has already tested the waters here. It sold a small amount of Bitcoin back in June, then followed with a modestly larger sale shortly after. And it has now sold approximately $218 million worth of Bitcoin year to date, largely to cover preferred dividend obligations. Compared against holdings worth well over $50 billion, that's a small percentage. But it broke the psychological seal on a promise that was, until recently, considered sacred in this space. Here's something worth pausing on. This is where the story takes an unexpected turn, because the biggest risk facing this company right now may not actually be Bitcoin's price at all. It may be the plumbing, the debt maturities, the refinancing windows, the capital markets access that gets tighter every time sentiment turns bearish. Are you positioned to understand moves like this before they hit the headlines? Or are you just watching the price candles and reacting after the fact? That distinction is going to matter a lot over the next few months. Let's zoom out, because this is not the first time markets have panicked over the possibility of forced selling. Go back to March 2020. Markets across every asset class, including Bitcoin, collapsed in a matter of days as leveraged positions were liquidated and panic spread through global finance. The fear of forced selling created a crash that, in hindsight, recovered within months. Look at the FTX collapse in late 2022. Billions in customer and company Bitcoin holdings were tied up, frozen, and eventually became a slow, court-supervised liquidation process that dragged on for years. The market feared a tidal wave of dumped coins. The actual selling, spread out and structured, ended up being far more manageable than the initial panic suggested. The Terra Luna collapse in 2022 triggered similar fears, a belief that contagion would force mass liquidations across the crypto industry. Some of that did happen. But the scale of actual forced selling was, again, smaller than the doomsday narratives predicted in the first 48 hours. Bitcoin miners have gone through their own version of this story repeatedly, selling portions of their holdings during difficult periods to cover operational costs, sparking short-term fears each time about supply hitting exchanges. And, of course, there's the long-running saga around old Mt. Gox holdings and various government-seized Bitcoin, both of which have triggered recurring waves of "here comes the supply" headlines for years, most of which turned out to be manageable, structured distributions rather than market-crushing dumps. The pattern across nearly every one of these events is remarkably consistent. Markets fear the potential of supply far more violently than they react to the actual supply once it arrives. The anticipation moves price more than the event itself. Could this be another version of that same story? A framework that sounds terrifying in a headline, but plays out as a slow, controlled, almost boring process in practice. Keep that pattern in mind, because we're going to come back to it. Now let's look at the other side of this argument, because it's a real one, and it's coming from serious institutional voices, not just Bitcoin optimists on social media. Analysts at Bernstein have described this shift as disciplined liability management rather than a sign of distress. Their reasoning centers on one important detail. Despite all the recent selling headlines, this company bought roughly 175,000 Bitcoin for approximately $14 billion earlier this year alone. Even after recent sales, it remains a substantial net buyer for the year as a whole. There's also the broader demand picture to consider. Spot Bitcoin exchange-traded funds have brought a wave of institutional capital into this asset class that simply didn't exist during previous cycles. Corporate treasuries beyond this one company have started experimenting with Bitcoin allocations. Interest from sovereign and quasi-sovereign entities continues to build in the background, even when it doesn't make daily headlines. Here's something most of the panic headlines conveniently ignore. Bitcoin trades tens of billions of dollars in volume every single day across global exchanges. A $5 billion theoretical maximum, spread out over time rather than dumped in a single block, is a rounding error against that kind of daily liquidity, not a market-ending event. Context changes everything here. A number sounds enormous in isolation, $5 billion. But measured against daily trading volume, against total market capitalization, against the actual pace at which this framework would realistically be used, the picture looks far less apocalyptic than the headline implies. On top of that, the company has been actively reducing its convertible debt, cutting it down to roughly $6.71 billion, an 18% reduction, including a notable repurchase of $1.5 billion of 2029 convertible notes at an 8% discount. It has also built its dollar reserves up from almost nothing to roughly $3.75 billion, and raised over $17 billion year to date through its at-the-market equity program. None of that sounds like a company in freefall. It sounds like a company tightening its financial armor while the market decides how nervous to be. Hit like on this video if this distinction between headline fear and underlying reality is starting to make sense to you. Let's pull the lens back even further, because there's a bigger question underneath all of this that deserves real attention. Institutional adoption of Bitcoin has not slowed down, even during this period of price weakness. Corporate treasuries, beyond just this one company, continue to explore digital asset allocations as a hedge against currency debasement and inflation. Nation-state level interest, while slower and quieter, continues to build in the background across multiple jurisdictions. Bitcoin's fixed supply of 21 million coins remains unchanged by any of this. Scarcity doesn't disappear because one large holder adjusts its capital strategy. The structural case for Bitcoin as a scarce, globally liquid asset hasn't been touched by any of these headlines. The exchange-traded fund ecosystem built around Bitcoin over the past couple of years has fundamentally changed who owns this asset and how they access it. Retirement accounts, institutional portfolios, and wealth managers now have simple, regulated pathways into Bitcoin exposure that simply didn't exist during earlier market cycles. So here's the real question worth sitting with. Is this actually a supply story at all? Or is it fundamentally a confidence story wearing a supply story's clothes? Because the numbers themselves, $5 billion against a market that trades tens of billions daily, against a total Bitcoin market capitalization in the trillions, don't scream existential threat. What moves markets here is belief. The belief that a major holder might be forced to sell creates more price impact in the short term than the actual mechanics of the selling itself. This is exactly why this moment matters right now, more than most headlines will admit. It's a test of whether the market's confidence in long-term Bitcoin adoption is strong enough to absorb a psychological shock, even when the underlying fundamentals haven't actually changed. Do you think the system can hold under this kind of pressure, or are we watching the first crack in a much bigger story? Comment your honest take below. I read every single one of them. Let's lay out exactly where this could go from here, because there are really three distinct paths worth watching. Scenario 1. The market overreacts to the framework itself, treats the $5 billion figure as if it were an announced sale rather than a ceiling, and Bitcoin's price recovers once it becomes clear that actual sales remain a small fraction of the theoretical maximum. Given the historical pattern we covered earlier, where fear of supply consistently outweighs actual supply impact, this scenario has meaningful probability behind it. Scenario 2. Financing conditions stay difficult. Interest rates remain unfriendly to further debt issuance. Equity markets stay skittish on this stock specifically. The company leans more heavily into this framework than expected, selling more consistently to cover obligations. creating a longer period of elevated volatility and a persistent low-grade supply overhang that keeps pressure on price for weeks or months. Scenario 3. Institutional demand through exchange-traded fund inflows, corporate adoption, and steady accumulation from long-term holders simply absorbs whatever supply this framework produces without much drama at all. The scare fades from headlines within a news cycle or two, and markets move on to the next story entirely. Which of these three do you personally believe is most likely? Drop your scenario number in the comments, 1, 2, or 3. I genuinely want to see where this audience's head is at on this. Let's bring this back to where we started. People hear the number $5 billion, and their brain immediately jumps to images of coins flooding onto exchanges and prices collapsing. That's how headlines are built to make you feel urgent, alarming, built for clicks rather than clarity. But markets aren't actually driven by headlines. They're driven by probability, by structure, and by whether the underlying fundamentals of an asset have genuinely changed or simply had a scary number attached to them for a news cycle. Right now, the real question isn't whether this company could sell more Bitcoin under this new framework. We already know it could. That's the entire point of the mechanism existing. The real question is whether investors believe the company will actually be forced to use it at meaningful scale, or whether this is simply prudent financial engineering dressed up as a crisis. Because in financial markets, fear itself often moves prices before a single coin ever changes hands. That's not a new lesson. It's one of the oldest lessons in this entire industry, and it keeps repeating in slightly different costumes every single cycle. The coming weeks are going to reveal which version of this story we're actually living through. A genuine early warning sign about corporate overleverage in the Bitcoin treasury model. A misunderstood, disciplined financing strategy that got wrapped in scary headlines. Or simply another news cycle that generated more fear than it ever generated actual selling. History suggests that understanding the difference between those three outcomes is exactly what separates long-term investors from short-term traders reacting to whatever headline crossed their screen this morning. If you've been watching for a while and this finally made the picture click for you, do me a favor and drop the word "positioned" in the comments below. I'm tracking which topics this audience wants me to go deeper on next, and that word is my signal to know this one landed. What would you do if scenario 2 actually plays out over the next few months? Are you positioned for that outcome, or just watching from the sidelines waiting to react? Be honest with yourself in the comments. This is exactly the kind of conversation this channel exists for. And tell me what you want broken down next. Should we go deep on how this company's convertible debt maturities are structured year by year? Should we dig into the exchange-traded fund flow data and what it's actually saying about institutional demand right now? Or do you want a full breakdown of how forced selling narratives played out historically across every major crypto crash? Drop your vote below, and the topic with the most requests becomes the next deep dive on this channel. If this video helped the picture click for you, hit subscribe so you stay ahead of what's coming next in the story, because this framework is not going away quietly. It's going to keep showing up in headlines for months. And if you know someone who owns this stock, holds Bitcoin directly, or just keeps asking you nervous questions about whether this changes everything, share this with them before the next headline hits. And they only get half the story. I'll see you in the next one.